is also here. So why don't you guys get going? We've got 2 mics for you guys, and we got 45, 50 minutes.
How are you? Good.
And this is the last panel of the day.
You know, it's a tough act to follow when you have such smart people like Andy and Suzanne and Joel. And they all have strong personalities and views. It's great to follow them. It's also a tough act to follow. They are very smart, entertaining individuals to have on a panel. It's always a great challenge and great fun to have them in that position. So
before we get started, can we offer up our 45 minutes back to that panel? Because they were pretty entertaining. That was awesome.
It was a terrific panel.
So I will get there.
You want to offer it up? Ben's going to body slam you just so we can match the entertainment value of the last one there, you know?
Give us the drinks.
This on the topic of private equity and purchase and acquisition. We're looking for
Your microphone is not on.
Mark, your microphone.
Howard set me up. Howard, great job moderating. Always a pleasure to follow you. Class act. Now they can hear me online. That's nice to have, especially since we have 2 of our panelists online. So with me today are Jason Frank, President and Compliance Officer of BDO Capital Advisors, Marty Fonke, a Certified Merger and Acquisitions Advisor for Westbound Road LLC. Jeffrey Mickelson is on the screen there. How you doing, Jeff? Good to see you again.
Good to see you as well.
Great. He is with partner of the transactional services with Cone Resnick Advisory. And here at the table, we have Ben Brandeis, founder and managing partner of New Origin Investments, a growth strategist in health, wellness, and aging. And he's got some interesting things to discuss about how he puts deals together and what the extra hurdles is that he goes through to make them happen. So we'll look forward to that conversation. My name is Mark Heil. I'm with Pickwick Capital Partners, FINRA registered advisors for middle market companies and alternative assets funds, providing specialized strategic advice on how to raise capital and how to do a merger and acquisition. We provide a full range of investment banking and fund placement services for public and privately held companies and institutions. So for the next hour or so, we're going to be up here talking and having a conversation. We want you to join the conversation, just like the last panel. Let's make this a little bit of fun, especially since the last panel of the evening or the day. So with that, let's start. Ben, you're the one closest to me. Why don't you introduce yourself?
Ben Brandeis. Why aren't you here, Jeff? I want to age gracefully. And I want to thank, number one, Marty and Peter for hosting this. Peter, I know you've mentioned this before. You're turning 60 and you want to be able to play hoop and all the things that you want to do. And I invest in products and services that are geared towards the aging population. So it's not only making it to later in life, maybe 90 and later, it's how do you make it well? And I love it.
Fantastic.
I have to follow that.
You do. Jason, take it away.
Jason Frank, President of BDO Capital Advisors. We're the investment banking arm of BDO. Buy side, sell side, debt and equity capital raising from institutional side, board advisory as well as ESOP advisory. Been an M&A banker for 30 plus years. I'll be lucky if I make it to 60. Forget about what he's talking about. Glad to be here.
Fantastic. Marty, we're going to have you go next if you'd be kind enough to introduce yourself.
Absolutely, happy to. I'm the unknown Marty that's not in the room, but thanks to the other Marty for inviting me to be here. My name is Marty Fonke with Westbound Road. We focus on lower middle market transactions in primarily digital and tech. And I've actually been listening into the last couple sessions. It's been quite enlightening, and I hope to bring some wisdom to the audience as well. So thanks for having me.
Jeffrey, it's your chance to get even with Ben here.
That's okay. I'll get even with them later. I'm assuming everyone can hear me. This is the first time I'm doing anything like this, but thank you to Marty and team for inviting me. Unfortunately, I had some commitments in New Jersey, so couldn't make it to the city. My name's Jeff Michelson, partner with Cohn Resnick's Transaction Advisory Services practice. We do buy-side and sell-side deals in the middle market, generally industry agnostic. That's what I do during the week. On the weekend, I help my family run a franchise deli business in New Jersey, similar to Katz's. So if anyone's ever out in the Morristown area, please let me know. We'll have a pastrami sandwich. So thanks again. Looking forward to the conversation today.
And they are good, by the way. I've attended events where he's catered, and they're excellent there. So thank you, Jeffrey.
And
Nice
I did
plug.
not pay you to say that, so that's good.
You mean the check's not in the mail? Come on. Ben, I'm going to start with you. And actually, that conversation we had over there on the side was pretty interesting to me. You face some unique challenges going after the businesses you go after as an independent sponsor. Talk to us about that. What do you look at, and different things you have to think about than say a large private equity firm would have to look at?
The only companies that I target are the ones that don't want to be sold. That's a challenge. So I say that is because I invest in entrepreneur, founder-friendly companies, but they do not want buyouts. They know that they need some help. They know that they need some professionalization, but they don't want to talk to, maybe yet, the Riverside Partners of the world. That's next step. So those are the companies I'm really interested in, because I can take a minority to larger investment in those, help them get to the next level, and then have the ability to work with a strategic or a larger PE fund on round two. Those are really tough to find, but I enjoy finding them.
Well, could you speak to how you structure deals and put them together? Because again, they don't want to be sold. So what are you getting out of this deal? How are you putting it together? How do you protect yourself in this situation so that you get your money back?
I have a tiered investment approach. So my initial investment dollars will come in a minority position with a board seat. So I have influence over the company with limited capital at risk. But then I have the ability to increase that capital, possibly at a fixed valuation day one. And I also attempt to have rights for first issuance of future equity when we do go to the larger private equity firms. So those are three criteria that are not easy to get. In order to get them, these companies definitively want help. And I need to convince them that we're the right group to help, which is why I focus on a very, very specialized niche. And this niche, I say aging solutions, can include durable medical equipment, behavioral health, online estate planning, things of that nature that you may not attribute just to making people healthier. It's living and working better. So I look and talk to a lot of entrepreneurs, which is what I enjoy the most, which is why I like the business. And I will tell you that as much as those entrepreneurs say that they want help, they want board membership, they want somebody like our group to be involved, it's still a very low percentage that I actually do deals with.
Now I'm betting Jason, and I'm betting Jeffrey, and I'm betting Marty see deals that are very different than yours. So
I hope so. I don't want them to see my deals.
So if you could, Jason, maybe you just start us off here and talk about what you're seeing today and how you're structuring deals to get them done and make them make sense to the buyer as well as to the seller.
Good question. I have a hard time figuring that out myself. We specialize in founder, family-owned, entrepreneurial type businesses, usually between 50 and 500 million of enterprise value. Usually the first question I ask new prospects is, what are you looking for? What do you want? You'd be surprised at how many little people really understand that. So the first step is really figuring out what their objectives are. Our job is to help them achieve that. It could be selling 100%, a majority, a minority. It could be finding a joint venture partner. It could be, vertical, horizontal growth, geographic, product, service, whatever it may be. That's not our determination of what they are looking for. It's trying to help them achieve it. In this type of marketplace, once we have that, we create the strategy and the materials and so forth, and figure out the right types of buyers to go to, both strategic as well as financial. It doesn't take much convincing these days, because it doesn't matter what type of investor you are, people are desperate for good quality deal flow. The credit panel before, in that world, there's plenty of stress out there. There's plenty of, B and C assets, a lot of hairy stuff that, someone's problem is someone else's gold mine and opportunity. That's not the world we play in. We play in good, healthy, growing, top line, bottom line, good industry type companies. Convincing buyers that they're the right asset and the right value proposition is pretty easy, actually. The difficulty comes with, it's a nice problem to have, but in this market, it's differentiate once you get all the IOIs and wanting to bring people to the next level, who's real and who's not. Who are the people that back up what they say and what they offer versus the ones that are, just going to downgrade the deal and retrade. That goes with experience. That goes with, like knowing who these people are, both on the strategic and financial side. But convincing the ultimate buyer of the true value proposition, it's not that hard these days.
Great. Jeffrey and Marty, I want to kick this out to you two. And Jeffrey, just go first if you don't mind. But lots of times you go in and hear the expectations of the owners, and they're not exactly aligned with what the market's willing to do right now. And Jason's smiling over here because he's glad I didn't ask him this question.
Oh, it's
So-
easy. Like everyone thinks their asset is worth like 20 times what it really is.
Well, see, and that's exactly right. So explain to me how you go through the education process with the client to bring them back down to earth, and how you then protect what they're trying to achieve.
Yeah, I mean, look, our role as the quality of earnings provider is really to come in and get the numbers right. We work with folks like Jason all the time on sell side processes to bring companies to market. Our job is to get the numbers right, but you certainly do have owners that think, they talk to a friend that just sold their business a year or two ago that got 20 times revenue, that's what they're going to get, and that's not always the case. So, as long as the numbers are right, I think the bankers can go out and get the valuations that they're looking for. But yes, you do have owners that certainly have expectations that are not the norm. We certainly bring our expertise to the table and tell them, directionally what they're going to get in terms of a multiple. But our job, again, as the accounting firm coming in to do the quality of earnings analysis, is to get the numbers right in the sense that they can be supported, on the buy side by diligence providers coming in. So, as long as we're doing our job, we let Jason and folks like them set the expectations on the multiples, which certainly may not be reasonable all the time.
Marty?
Yeah, I mean, you hit the nail on the head with valuation expectations. Our market focus tends to be a little bit lower middle market. We do $10 to $50 million as our average deal size. So our owners and founders tend to be younger, bootstrap businesses. They did not take VC money at the beginning. They're doing $20-30 million a year in revenue maybe, and they've hit that wall where they need capital, but they're not really ready for VC. Or they're not, they're above or beyond the VC stage. And so when we start looking at PE and things like that, they're expecting like VC tech valuations that they read about, in the press, and you got to bring back to reality. It's a constant battle that we fight, and it's really just about education, which educating them. What's the difference between that type of valuation that they've seen or read about and their valuation, and then just breaking that down for them. And so and then also, as Jeffrey said, like getting the numbers right. Oftentimes, getting the QoE analysis done, et cetera, and breaking it down and really educating the founders, because we work with a lot of younger founders that they're going 95 miles an hour without taking a breath, and they're just like, well, certainly it's got to be this. And so it's about slowing them down, making sure the fundamentals are there, and then educating the heck out of them until they understand what they have as an asset class. So.
Speaking of valuations, in a couple of weeks, we're expecting an announcement from the Fed. Many people are anticipating that the number's going to drop. We're currently seeing, valuations to certain sectors as high as 11 or 12%, depending where they are, which country they're in. What's your expectation of what's going to happen, and how's that going to affect the valuations? And Jeff, I'm going to kick that out to you first, since you're the one crunching the numbers and looking at that all the time.
Oh boy. Yeah, you gave me the tough question first. Okay. I mean, look, on the sell side, when we come in, there's the expectation that a deal is going to go to market, right? Unless something's in the numbers that tells you otherwise. On the buy side, again, usually by the time we're coming in, there's an LOI in place. And so there's, again, that expectation that a deal is going to happen. As far as how any uncertainty, whether it's interest rates, tariffs, political uncertainty affects the overall market, I mean, I think what we're seeing is generally we're past most of that, not all of it. And our clients are certainly more active than they were on the buy side, even a month or two ago. But again, on the sell side, when we're coming in, there's a incentive to go to market. And so we're, again, doing our work up front, bring the company to market. What the offers that come in are and how they're valued is kind of beyond our control. But certainly we're more active than we were. And I think interest rates and tariffs kind of in the rearview mirror is certainly a big part of that.
Jason, do you want to follow on, or do you want to?
Sure. I personally think, yes, interest rates are going to go down. It's going to decrease cost of capital. It's going to facilitate deals getting done. Hopefully banks get back in, but it doesn't really matter because the private debt market is so frothy. In my opinion, it's not going to change valuations. It's just going to facilitate deals.
It's going to make deals easier to get done.
Correct.
I agree.
Marty, concur on that?
Yeah, absolutely agree. I mean, we're not going to see enough of a rate reduction that's going to, fundamentally shift the market valuations or anything else. Just going to make deals that are, a little bit easier to get done. But I don't see us getting, huge fundamental changes. So.
And what are you seeing right now in the market in terms of exits? The momentum for exits, I guess. And what are you anticipating? I heard you just speak a second ago there, Jason, that you thought the interest rates might help loosen up and make that market a little bit more viable. What are you seeing right now, and what is your anticipation?
So you're referring to PE exits?
That's correct.
Private equity funds have a lot more to worry about than just interest rates. I know there's some very good performing
not
funds.
Necessarily is tied to interest rates.
Yeah, there's some really good performing funds. So like I'm talking in generalities from the market perspective. I mean, they're dealing with, they're sitting on tons of dry powder that they can't deploy. They're sitting on a very aged portfolio that they haven't sold because valuation aren't where they want it to be able to get the IRR that they want. They're having really difficult times raising new funds. Interest rates, yeah, helps, but they got a lot more to worry about. Massive amount of competition. I personally think there needs to be consolidation among private equity funds because there's just too many of them with too much money. Too many of them are getting over their skis and bidding too high for deals that they shouldn't be bidding on, excuse me. They're because the deal flow is lacking, they're looking beyond their original investment theses and doing, different industries, different levels of credit. And all different types of asset classes that they don't really know what they're doing. They got enough to worry about more than interest rates.
And how has this affected, Marty? I'm going to throw this one out to you. How's this affected who the buyers are? Are you seeing there's been a lot of strategic buying recently? Are you seeing different types of buyers now step up to the plates? Do you think the IPO market might come back? What are your thoughts on this?
Well, we play, a couple notches down below the IPO market. So we're not really seeing that. I will say, I mean, we've seen in the last 3 weeks, probably more interest in buy side interest than we saw in the 6 months prior. I mean, between tariffs and everything else, it's been a weird year. But as was just mentioned, I mean, there's dry powder that's sitting there. It needs to be deployed. It's losing money if it's not making money, right? So we're seeing people realizing they've got to make something happen. They've got to deploy that. They've got to get those investments out there. And so in the private equity panel earlier today, somebody mentioned that that really only the A deals are getting done. And some of the B and C deals are have been kind of languishing, and I think that that's absolutely been true, but I think we're starting to see, and you know, you mentioned getting over their skis a little bit. I think we're starting to see almost a not a desperation, but a over eagerness to get deals done, especially by the end of the year and get deployed because you know people are expecting returns, people are expecting action. So it's been an interesting month, and I'm seeing some nodding heads. So I'd love to see what everyone else is seeing. Just in really the last 3 to 4 weeks, it's been kind of wild.
So you want to take this, Ben?
Yeah, I would say that
Get a little
On
closer to the mic. Thanks.
on interest rates, the companies that I'm involved in don't care.
Mhm.
They should maybe a little bit, but they're fighting other battles that are way more important than the Federal Reserve. The entrepreneurs and the companies that I'm involved in are anywhere, let's say, between 10 to $50 million of enterprise value. So they're small. They're not VC. But even at a $50 million enterprise value, they're fighting fires every minute, every day, all year, every year. That's personnel, that's manufacturing. So, you know, the political atmosphere, the Federal Reserve, geopolitics is not on their top of mind. In terms of exits, I would say that cash is king.
Mhm.
If you've got cash and you don't want to use leverage, the world's your oyster with smaller deals. If you're an independent sponsor, it's even better because everybody else is acquiring deals using quote unquote creative strategies such as seller notes, preferred, deferred compensation, all kinds of things. And once companies start hearing about that, they start tuning out. So in this day, liquidity and cash is king. You can get better valuations, you can get better deals. And, you know, that's the type of situation I focused on. I used to always focus on all these quick creative solutions because they were cool and they were fun to model out. And you know something? They never worked. Writing checks seems like that works a lot better.
I would agree 100%. Jeffrey, I want to come to you because especially for the company sizes that Ben is talking about, lots of times when you go through their quality of earnings, if you will, there's a lot of add backs and things like that that can be worked into the numbers here. Talk about your process for identifying those and what you go through to really get these companies ready for market.
Oh, that's a great question, and I think it's better served over a beer for sure, because yeah, every situation's very different.
What are we serving?
I'll come into the safe for that for sure. Yeah, look, I mean, again, on the sell side, our job is to come up with these concepts for when the company goes to market, right? So we're working with the management team, the bankers like Jason, to identify these concepts. And I think what we're seeing on the sell side is people are getting aggressive and being aggressive, but within reason. You know, they don't want to go out to market with 10 to, 20 lines of ad backs and then have them, you know, debated on the buy side calls. I think we're trying to be reasonable and go out to market with what we think a buyer will accept. On the buy side, we're certainly seeing more sellers be aggressive with their ad backs, especially around tariffs and non-recurring RIFs, things like that. But our job is to make sure they make sense and make sure they're supportable and make sure that, you know, a buyer coming in is going to inherit the run rate of EBITDA that the seller's presenting to us. So, yeah, I think we're seeing certainly more ad backs than we were maybe a year or two ago, but I wouldn't say it's much more. And I think our clients are making sure that all those ad backs are credible and supportable. The other quick area I'll say is in the concept of more pro forma concepts where there's execution risk tied to the ad back. We are seeing a bit more of that on the buy side where people are coming in and saying, oh, look, you know, we just signed up this new customer or, you know, there's a change in the contract. We want credit at 100% for this ad back. And again, you know, sometimes we'll give them credit, but a lot of times we won't because it's just not supportable or there's still execution risk for it. So yeah, that's our job and we're doing it. And I would say that the sellers are definitely being a little bit more aggressive with the ad backs now.
Let me ask this because, sometimes part of the thesis of the acquisitions, bringing new technology, to make the manufacturing plant more efficient. How do you handle that in your pro formas and your anticipation?
Yeah, I mean, we have a team that comes in, especially around technology and IT and AI. We are seeing some companies say, oh, we're reducing heads and moving to a technology or an AI centered, uh, whether it's customer service or operationally, they're bringing AI technology. Yeah, look, we work with our clients. I mean, sometimes they know the sector as well as we do, and they can opine on whether they want to give credit for those ad backs. But we are seeing a lot more RIFs, and a lot of that is being driven by technology and AI, and I think that's going to continue going forward, where we see these reductions in force due to technology implementation. And again, it's all about working with our client to say, are you comfortable with this run rate, and are you comfortable getting behind, what they're proposing? But it is definitely more frequent now for sure. Technology coming in.
Great. One of the things I've seen with what we do is we work with a couple of manufacturers, and it seems like foreign companies want to come in and either acquire them or develop strategic relationships with them to build here their products rather than import them due to the tariffs. Are you seeing a lot of that, Jason?
Yeah, it really started in February when the administration figured out how to spell tariff. And then each successive Liberation Day that we've had since, we've gotten from our international colleagues, I probably get 15 calls a week from companies looking to enter the US to either deal with tariffs, supply chain, or just simply, facilitate their growth initiatives. And it makes all the sense in the world. The biggest issue that we've come across in doing those types of relationships and those types of deals is from whatever country they're calling from, they're used to the dynamics and the deal dynamics within their own country, which are significantly different than here in the United States. And trying to get over that hump and explain it to them, that's a big battle.
It's certainly a challenge. Marty, do you have any thoughts along those lines?
I don't think I can add anything to that. We're seeing similar things, so I don't want to be redundant.
Fair enough.
Yeah,
Thank
Brian,
you.
just
Sorry.
one real quick just on that. I think what we're seeing a lot, especially around supply chain issues and tariffs, is that a lot of these companies went through this, 4 or 5 years ago, and I think they have a better handle on how to react to it. It may not be necessarily 100% the same, but a lot of the companies we're speaking with in the manufacturing space have been through this war before, and I think they have a better approach to it now than they did when it first happened a few years back.
I'd agree with that statement, but I still think there are challenges in that a lot of these, particularly if you're talking about certain metals or certain things, are coming from countries that aren't necessarily friendly to the U.S., right? I may want to see U.S. interests not succeed, which is making it harder on these companies to get what they need to produce. So have you seen any strategies around them trying to secure that better line, a better supply chain, if you will? And that can be for any of you.
I'll jump in. I don't want to get political, but our who we thought were once friends are now not, and who we thought weren't friends now are. So I don't know if that statement really helps or changes much. I think businesses do what's best for their best interests, and play within the rules and regulations and legal parameters. But they're going to do whatever it takes to be successful, as they should. So if the right sourcing is from a location or from a country that maybe was a friend or wasn't a friend or whatever it is, as long as they're doing it legally, go do it.
Marty, do you have any stories or anything you'd like to share along those lines?
No, I was just laughing because Jason, so you don't want to get political, but the thing is that politics affects business. You have to be political. You have to think about what's happening in the political climate, whether domestically or abroad. And so, the panel before us, they went down a whole rabbit hole about the, potential next mayor of New York. So I don't know that we're gonna cross any lines that they already didn't. They already didn't. But you have to be political. You have to think about what's happening with politics with regard to business, or you're burying your head in the sand. So.
Ben, you obviously have something to say.
I think that it's great practice to understand that the world is uncertain, and we may perceive it, the political atmosphere, to be more uncertain than ever. I'm not sure that's the case, but companies and the entrepreneurs and the founders that I'm dealing with are learning how to accept uncertainty better in this environment. And I think that's a good thing. There's a company I'm not invested in. I'd love to be an investor in, but they are a manufacturer of mobility devices, and they have a manufacturing plant in Randolph, Mass. Hard to believe. It's about 100,000 square feet. And they import a bunch of steel from China. And at one point in time, they were crushed by prices. I don't know, a month later, they weren't. So had that ever happened to them before? Not in the history of their life had such levels of different types of costs and supply issues that hit them. So at first, there was a little shock and awe. And at second, they adjusted. And they're a little bit better for it. And it's probably not going to improve. Good for them. That's the type of company I want to be involved in.
Mm-hmm.
So one of the things I want to talk about is sector hotspots. Technology and healthcare dominated the 2024 buyout market, fueled by AI and farmer opportunities. What sectors do you see gaining the most traction in M&A and private equity over the next, let's say, through the end of the year? But that's a short thing, so let's go out to 2027. And Jason, I'm throwing that one at you first.
Okay. Yeah, pharma, healthcare, technology, those are the obvious ones. Financial services has really started to pick up, both on the strategic as well as financial buyers. A lot of consolidation going on there. There's also been a lot of, well, it's a new dynamic, or at least a newer dynamic in today's environment. A lot of big corporates are breaking up. They're splitting up. Could be food, could be consumer. There's just a lot of opportunity right now. There's a lot of capital and liquidity out there, and there's a lot of opportunity in a lot of different industries. It's funny, like the least attractive being like manufacturing and heavy industrial. They're always going to be around. There's always going to be activity, but they don't garner the highest multiples. So they're not like the hot, sexy industries. But for all industries moving forward, there's a lot of optimism for transactions.
Yeah, and the interesting thing about the industrials is they come with plants and expensive plants, right? And people say, you need a whole bunch of parts that only work for your business here. And I don't want to be stuck with those parts at the end of the day if the things don't go right. So that's always an interesting twist on things. Marty, I want to get your thoughts in here.
I'm glad you said that. I was actually just going to jump in because one of the sectors that I see, a lot of optimism is supply chain automation, especially where AI is applied. Think robotics, logistics tech, and things like that, which exactly addresses what you just brought up. So that so kudos to you, Mark. But yeah, I don't see as much interest in owning the manufacturing plant as it is owning the technology driving the manufacturing plant, and that's we're seeing a lot of interest in those areas, especially where you can make things more efficient and automated with AI applications. So we're seeing a great deal of interest in that area.
One of the areas that we've noticed a lot of activity in, and we're pretty active in, is in the defense industry. So you certainly have a lot going on in space, I'd say right now. That's very interesting. We have a lot going on, still in the aero space, and within the Earth's atmosphere. Planes and travel that way is still pretty interesting. Both on the commercial side and on the military side, those things. So again, those are areas that we're seeing, and I'm still seeing some activity in drones. It's shifted a little bit, and then the anti-drone technologies have started to really bubble up and become interesting to different companies. So those are just things that we're seeing in our practice.
I have no predictions. And if you told me, now that you told me those predictions, Mark, thank you. I do not want to invest in them. Okay.
Wouldn't expect. so.
Nothing personal. Because I'm trying to uncover, I'll try to uncover things that people are predicting wrong or they haven't put enough analysis into it. That being said, I invest in the aging market. So apparently that's obvious that people are aging. But what I didn't predict is the level of demand outweighing the supply more than any other industry that I've ever seen. And the gap is widening. We all know the statistics, they're not secret. But you go out into the market, there's just not enough stuff out there. And there's not enough good stuff, and it's too costly, and there's things that can be done. And that's where I see the excitement.
Now, I mean, in the real estate space, although you can question whether or not they're real estate deals, right? You're seeing a lot in long-term care, assisted living communities, things along those lines. It's still a fairly hot sector.
Let's put them all together. Ben, technology changing and aging and healthcare. What do we get?
Well, you get a company that I'm involved in. I don't want to say AI, okay, but one of my portfolio companies is an online estate planning company. So it helps people with their wills and estates and etc. It's geared towards anyone, but especially relevant to the senior population because there's many seniors of all kinds of demographics, wealth, income level, geographical location that do not have these documents, or the documents are so outdated that they're basically irrelevant, or they may be in the wrong state, or they didn't have the right beneficiaries, or no one has access to them, or the lawyer can't be found. Shocking. So to me, maybe that's not answering your question, but this is where technology intercedes with the aging population and providing tools that are available, for people's use that are better than what exists now. But maybe that's not answering your question. I think I answered the only question that I wanted to answer. So
You wanted to hear like robotics or something.
He made an interesting investment, but he doesn't want to talk about it right now. So that's fair enough. We won't put him under the light there.
Well, I do have an example of that. If I think I heard the question correctly from the
Fire
audience
away.
members, can you repeat what the question was?
Technology and disrupting the entire aging longevity healthcare market.
Did you hear that? It's
Technology
technology
disrupting.
Right. Technology disrupting the aging.
Okay, I don't have an example for that. I have an example of technology being leveraged, but I don't know that I have a disrupting story, so I'll hold off. So,
wealth management, retirement planning, is it robotic pets, mobility devices that set with sensors on them that can measure vital signs? Is that it? Okay.
My suggestion is the robotic rat killer for New York
We
City.
had that discussion at dinner last night.
What an awful dinner discussion.
Yeah.
wow.
Well, it started off, you have to hear the story. Marty will tell it over beer sometime. See that, Jeff? Now you have to come into the city.
Replacement parts, bodily replacement parts. I'm going to get this. Is that it? Come on. Okay.
All right, we're going to move on.
Ben's determined.
One of the things that I want to do is really drill down. We've talked about some of the challenges we've seen over the last couple of years. We've talked about, how they're impacting the businesses. Jeffrey has translated them to the financial statements. But I want to talk about diligencing deals right now. How do you diligence them when you find them and make sure that they are what they say they are? And Jason, has that changed for you recently? Are you focused more in certain areas? Are you doing certain things differently?
Over 30 years, our level of diligence hasn't changed. We only take on projects that we're in agreement with the owners, we're in agreement with their objectives, and it's a legitimate situation. They are who they are and they say what they say. And we only take on, knowing all that, we only take on projects that we think we can execute.
So in diligence, you never turned up a piece of information and said, "Oh my God."
Oh,
what
it does
the
all the
hell?"
time. And we just don't take them up. Like
Right. You
but
were
at that,
terminated at that point.
our level of diligence today is still the same as it was 30 years ago. We don't
Okay.
change.
No, I followed that, but I just wanted to make sure for everybody out there that you know.
Oh, no, there's plenty of messes that we don't move forward with, be it personal from the owner's standpoint, from business, from financial, from operational risk, you name it. I mean, there's always things that come up. But if that's, look, they are who they are. But we're not going to take on a project with those types of risks because we have to explain it to people.
Exactly. Exactly. And we, especially in a tough market like today, you want to throw out pitches to your investors that are right down the middle without any hair.
You might be surprised to hear this from an investment banker, but I think reputation is pretty important. Yeah. We tell people what they need to hear, not what they want to hear, both from the owners as well as the buyers. Life's too short. Don't get involved with these people.
I just want to say one thing, and I'm going to add a minute because I know my question is going to take my statement will take 30 seconds. So we'll add a minute to your time, Mark. But I think reputational risk is something that family offices do not account for enough. We had a guy who was doing not payday lending, but I guess it was obviously the most famous guy who does subprime auto loans is out of Southern California named Don Hankey, right? But he was doing something along those lines. And I said, isn't there a lot of reputational risk from having this? From, somebody was trying to raise $100 million. One of the founders of Microsoft was financing it, right? And the guy was diagnosed with cancer. He was getting out of the business, taking his money back, et cetera. Incredibly profitable business. The default rate is 50% within 18 months. And the rates they charge are 38%, 40% interest rates, right? So I said, what about reputation? Oh, there's no reputational risk. The guy who was selling it. 2 weeks later, the New York Times Business, there's a headline front page that says, subprime loans in the car business is killing America. Woman drives her kids to camp, Boy Scout camp, goes to, stops at Walmart to buy stuff for the camp. And the payday company or the company that did the loan put a stop on her car. They had the automatic transmission killer, so another person was driving to work and their Southern California freeway traffic stops. They had the ability to kill your car. If there's a traffic stop, they killed her car and just story after story about it. So a lot of times I think for family offices, reputational risk really matters in terms of what position you're getting into.
Absolutely. Absolutely.
You don't want to be the family that financed that.
Well, one of the
You're in the
things
headlines.
we look at as investment banking, I'm sure Jason does, and I'm sure Marty does too, is, you look at that issue when you're taking them, if you're on the sell side, you check that out before you take it to people. Hey, is this going to come back and bite somebody? Is this going to look bad on us in 5 years because we took this out? We don't want that.
Well, if you're getting gets the paper,
Well, you had that with Viatica when it first came out. That's another one where this really happened. Today, it seems like that's a little more accepted, but 20 years ago, that was, considered the cool pool for finance for Wall Street, right? We're betting on you're going to die and, leave a lot of money behind. So that was all interesting. That's right in your wellness area here, by the way.
Yeah.
After that, they're not laying on the pavement after that. No, market's repossessed. I mean, it works the way it's supposed to. Unfortunately, the New York Times, the Wall Street Journal. It's supposed to. Yeah, we used to put two devices, one in the front, the one in the back. They thought they put the one in the front. They didn't realize we had a second one. But we didn't put the financing. Somewhere else.
And next time we'll be previewing the movie Repo Man.
There you go. You ever see that movie? That was pretty funny.
Wait, just Marty, when you say reputational risk, can that be solved by reputational due diligence? Is that what, are family offices not doing the type of due diligence on the people that they should?
I mean, it's in some respects, that type of product exploded in popularity. So you were just, in the old days, you were just a family office printing money because the returns were so high. But you were staking a guy who was running the business, right? But then all of a sudden, once the New York Times ran the article and Wall Street Journal, you didn't want to be involved in, it's like kryptonite, right? So you could have done it, but I mean, who anticipates this stuff?
And you're never going to anticipate it all. You're always going to run into that situation, which is why, excuse me, those PR agencies exist.
Right. But I'm just saying that, well, that's why the family office wants to have a CIO who's like thinking not just about the returns, but also about the value of the family office brand.
Exactly right. Exactly right.
The companies that I look at, and usually I'm referred to people by many people before I find them, before I find those entrepreneurs. So they either know something about me, they've heard about the group or what have you. But I will tell you that the more due diligence they do on our group, the better I feel. And in fact, in some cases, when like I give a list of references and I find out that they didn't call them, it actually makes me very nervous. So it's almost a requirement
I
because
personally never understood the idea of references. I mean, in concept, it makes sense, but when you ask somebody to give references, who do you think you're going to get?
yeah,
I mean,
right.
they're going to give you positive news. It's
Their best friend and their mom.
We have the guy, here's his friends, how do they reach him? That's the purpose of the
it's like, tell me a reference
Right.
that ever gave a bad reference.
Right. This is what I should clarify. You're right. Indirect.
Jump in, Mark.
Right. Indirect. So, I mean, I'm not giving them,
Yeah.
I used to give people a list and it used to be my friends, my cousin, my dog. Now, you can, do a bunch of social media. You can ask somebody's fifth connection who, may not have liked them. You can ask somebody who you didn't get along with, or maybe you did do a bad deal with. So there's lots of ways to get that due diligence, but I also give
Now
them
it's just
my friends.
ChatGPT.
That's all they do it. Wait, before we go on, I got 3 more for you. AI and technology. Okay. Mental health, communication with family members, doctors, and others, and wearable devices. But you were thinking of something.
I want to hear your opinion. I know
But none of that met the criteria. None of that was it.
He's going to keep you on the edge of your seat.
I wanted to chime in on something Jeffrey said. He said, however many 30 years your due diligence checklist hasn't changed or whatever, which is it's just true. But what I see with buyers is they always have a focus that is the most important thing on the checklist, right? And that evolves. 2021, it was very much supply chain and can we actually put products in this business. And this year it's obviously very much focused on tariff risks, and we're seeing more and more less focus on tariffs and more on inflation mitigation. So the checklist of due diligence items, I think, is the same, year in and year out, but what is important to people and what they're looking at changes depending on what's going on. And that's what it's, that bright, shiny object syndrome. So you got to look at it all, but there's always something, 1 or 2 things that every buyer's most keyed in on.
Excellent point. Thank you. And I want to thank the audience this afternoon. Stay until the end. Give yourselves a round of applause. Thank you. Great job by our panelists here, Jason, Ben, Jeffrey, Marty. Thank you so much. And we'll see you in a couple months. Thank you.
Think so?
Our schedule is on the back page of the agenda for today. So we're going to be back here in November. We're in Miami for Hard Falls on December 3rd and 4th. We'll be in San Francisco for J. Morgan Healthcare Week, and then we're back here in February. And we have podcast filming that we'll be doing as well. So we typically do 2 days of podcast filming around the events, and then we have a couple of wild card dates. We'll be in Miami during Hedge Fund Week and during Global Alts Week. Thanks, guys.